According to the latest Bank of America flow data, clients were net buyers last week of large and mid-cap stocks, but they were sellers of the small caps. And according to their fund manager survey, 44% say large cap stocks will outperform small caps this year. That's a rise from the previous reading. Small caps have continued to underperform, with the Russell 2000 only up 1.5% so far this year. My next guest, though, remains near-term cautious on the index, as she doesn't expect any Fed cuts this year. Well, joining me now is BofA's head of U.S. small and mid-cap strategy, Carey. Jill, it's great to speak with you today.
Great. Thanks for having me.
So why do you remain cautious here?
Well, I think we've thought about multiple reasons why small caps could continue to lag. We've been cautious for a while, since last year, on the Russell 2000, and I think near term some of those reasons still hold. So, tariff risk is one of them. We've seen small caps earnings see a bigger impact from tariffs because they have thinner margins, and the effective tariff rates might settle a little higher than many were expecting, based on some of the recent numbers and deals. Another is the Fed. So, as you mentioned, we're not expecting the Fed to be able to cut this year. The market's still pricing in a few cuts. We don't think today's CPI was a game changer. I think if we'll look at the PPI data this week, which will also be important. But for now, our house view is that, inflation has remained sticky. The Fed will remain on hold this year. And we know that the Russell 2000 has been very correlated to Fed expectations and interest rates. So, if the Fed doesn't cut, that could be a near-term negative surprise to market participants who were expecting some cuts, which, cuts tend to be a positive for the Russell. That is a very interest rate sensitive index, has a lot of refinancing risk.
Okay.
And the earnings backdrop's the other one. And that's where we're starting to see some green shoots, but still mixed. So, the earnings backdrop, everyone had been expecting last year, when you look at consensus expectations, that small cap earnings after being in a recession would recover faster and bigger than large cap earnings growth. We didn't see that happen yet, and the recovery has continued to get pushed out. Now, this quarter, we finally did see earnings growth turn back to positive for small caps. It surprised to the upside, but there's still pretty lofty expectations baked in for the second half, and the top line trends were still much more lackluster than we saw in large caps.
Okay, so if you don't like small caps or the Russell 2000 here, what do you like?
I think it still makes sense to be selective within SMID caps. Overall, we do like mid caps over small. Within that SMID universe, you've got cleaner balance sheets, less risk from factors like tariffs and refinancing risk. But even within small, I think there's still a lot of opportunities. You have wider performance spreads, more alpha opportunity, and the valuations are still relatively cheap versus large caps. So it's still the least expensive size segment, and I think you just need to be more selective. The Russell 2000 has also gotten lower quality over time. You have more non-profitable stocks, and despite the recent rally that we've seen in micro caps, typically over the longer term, quality tends to be a factor that small cap investors favor, and that's rewarded. So, we would still focus on higher quality areas within SMID, tilt up toward mid, focus on stocks that are seeing positive revisions, stocks that have stronger margins amid the tariff risk. So more of a stock pickers and active backdrop rather than just buying the index.